This is Chapter 2. Students are introduced to insurable loss exposures. The purpose of this chapter is to clearly and logically present the necessary criteria for a proper insurance pool that result in an opportunity for an insurance company to make money and be sustainable over the long run. The characteristics of the exposures that can be insured may be quite different than the ones people want insured. Insurers are constrained by the necessity of staying in business and making a profit, whereas consumers individually desire their losses to be paid. Before putting up the overhead, I usually ask the students to pretend that they are developing their own criteria for operating an insurance company and instruct them to write down a set of factors they would use to determine if an exposure was insurable. It is interesting to see how close students come to the criteria insurance companies use. This is the ideal set of criteria. Insurers need a large number of exposures so that law of large numbers may operate and the loss becomes predictable with a degree of certainty. The homogeneous dimension is that the exposures are similar in characteristics and dollar size. Losses should be accidental and unintentional from the point of view of the insured. Many losses are intentional, but just as long as the insured did not do it, an arsonist who is not the insured, the loss is deemed to be accidental from the insured's point of view. This is required so that the losses are random and conform to a statistical distribution. The third criteria is required to make sure that the damage is measurable, determinable in time and place, and you can generally determine the cause. The sufficient severity requirement is used to make sure that the insured has something to lose and will be interested in the event not happening. The company must not be subject to simultaneous losses of a large number of its exposures. Insurers need geographic spread, for example. How an insured decides what to insure is an interesting process. This is decidedly different than the insurer's point of view. Is the value of the potential loss worth protecting? Probability of loss is important here because it impacts the premium paid. I talk about why the probability of loss does not appear in the insurance company's criteria. Insurance companies would love to insure high probability events because there is less objective risk. In other words, since they are more certain that the loss will occur, the insurer's risk associated with predictability is lower. The industry works well when the premiums flowing in cover the losses going out. This balance needs to be maintained for the proper operation of the insurance pool. I discuss what happens when the balance between cash flow coming in and going out gets out of balance. Examples of this process abound in the liability field, automobile insurance and daycare insurance among others. I concentrate on illustrating what will happen if either the frequency or severity of losses increase. The result is premiums must increase. In turn, some policyholders decide that the coverage is too expensive. People perceiving a higher loss potential remain and the other people leave the pool. Increased premiums results from higher losses. This process continues until possibly the pool is no longer feasible. This provides information about a recent large loss and the results of paying the claims. Over the years, various solutions have been employed to handle large losses such as beach plans and the federal flood insurance program. Insurance companies and society should appreciate the goal of risk classification, which is to generate a fair premium for all insureds. When a fair premium is charged, it tends to minimize subsidization and adverse selection. I discuss the 4 factors used to evaluate classification schemes. Each factor follows. Adverse selection, subsidization and self-selection are discussed. Why are insurers worried about this? And what happens if it progresses to the extreme? Adverse selection is the result of asymmetric information. In general, insureds know more about the exposure than the insurer. When all relevant information is not disclosed, it generally causes people to pay less than they should. This results in an averaging where one group pays too much while the other too little. One group is said to subsidize the other. Self-selection is where people are in a pool but choose to get out or stay in based on their own preferences. For example, people in great health may drop their life insurance as their term rates increase. People in poor health will tend to stay in the pool. This causes the actual mortality rate to be higher than when both groups are pooled together. When government eliminates classification schemes, it eliminates a method of competing in the industry and providing fairer rates. Competition minimizes the subsidization and provides a method for fairer pricing. I explain this process. Classification Factor 1. This criteria means that you need a large number of similar exposures in each classification. and exposures in a class will exhibit essentially the same loss probability. This criterion makes insurance fair and minimizes subsidization. Classification factor 2. Insurers must be able to verify information that they acquire for rating purposes. The information must not be subject to manipulation in that the insured will volunteer an answer that results in a lower premium. Classification factor 3. When a factor has incentive value, it means that the insured can positively change behavior and lower rates. The lower rate is a function of a lower frequency or severity expectation. Classification factor 4. The last criteria is the most difficult to deal with. Some factors that are statistically significant and should be used clash with the concept of social acceptability. For example, using sex as a rating criteria may not be socially acceptable, but it may be statistically accurate since males versus females have different loss rates for life insurance and automobile insurance. These are some important social issues. I develop a connection between the insurance industry, social problems, and the possible solution to the problems. In anticipation of talking about the entire insurance industry, I provide a broad overview of the parts of the industry and generally the exposures that they handle. I point out that there are government-sponsored insurance plans such as Social Security, federal flood, federal export, import insurance, among others. The private insurance industry does not cover these items because they significantly violate at least one of the criteria for insurability. The second purpose is to provide insight into the insurance industry's production of successful insurance contracts based on the criteria identified in the chapter. Clearly, this is not an exhaustive list. Beyond physical damage issues, the concept of insurability extends to the social responsibility of being responsible for the injury one causes others. I provide a foundation for the concept of legal liability and the types of damages that occur. I use cases to introduce the liability area. State Farm Fire and Casualty Co. v. SS 858 SW2D 374 insured was sued by a former girlfriend for infecting her with herpes. State Farm denied coverage under his HO policy, saying that since he knew that he had herpes, the injury was intentional. Supreme Court ruled that since the insurer could not establish that the insured was aware his herpes was active at the time and that by engaging in sexual relations it would be transferred to his partner, there was no evidence that the resulting injury was intentional. Thus, the insurer had to cover the claim. Mile v. State Farm Mutt. Auto. INS. 908 SW2D 289. Mile shot a BB gun into a crowd and hit someone. He argued that the insurer should defend him because he did not intend to injure anyone, he merely wanted to laugh at a reaction. The court ruled that although he didn't intend harm, he should have reasonably expected harm to occur, and thus said that State Farm did not have to defend him. While this is not an auto case, the same legal principles apply in all liability policies that contain this exclusion. Mayer v. Trinity Lloyd's Inns. Co. 850 SW2D 193. A stepfather molested his minor stepdaughter. Trinity denied coverage for the father, saying that he intentionally inflicted injuries. The court ruled that under any situation injury, harm could be reasonably expected, and affirmed Trinity's denial of the claim. State Farm Fire and Casualty Co. v. Reed, 873 SW2D 698. A woman operating a home daycare was sued by parents of a child who was injured. The child crawled through a hole in the fence separating the play area from the pool and drowned. The parents sued Reed for wrongful death, and State Farm denied coverage for Reed using this exclusion. The court ruled that maintenance of the fence surrounding the home is a non-business pursuit and thus coverage existed under the policy. In a broad context, legal liability arises out of torts, breaches of contracts, and criminal wrongs. Unintentional torts are generally insurable, intentional ones are not. Breaches of contracts are not insurable. Criminal wrongs are not insurable. I describe these and ask which of these are insurable, why or why not. An insurance context categorization is used to describe torts. Torts are categorized into deliberate or intentional interference liability without fault, and negligence. See next slide. This is an insurance categorization which is useful in deciding which torts are insurable. Deliberate acts with intended consequences are not insurable. Liability without fault is insurable because from the insured's point of view the loss is unintentional. Negligence is insurable. A requirement of negligence is that the injury results are unintentional. Negligence is defined. The reasonable man standard is discussed based on legal use and based on a practical sense of who a reasonable person is. With respect to the court, the jury decides what the facts truly are based on the plaintiff's and defendant's case and apply the appropriate law as instructed by the judge. Even though you may not be directly involved in the injury, you may be held legally liable. Vicarious liability, being responsible for others. Joint and several liability, if you are only partly to blame, you may be held responsible for the entire injury. You then may proceed against all the other parties who were also responsible for restitution. To establish negligence, the plaintiff must show that there was a legal duty to do something or to refrain from doing something, a failure of the duty and injury, a causal connection between the injury and the failure of the duty. The jury bases its decision on weighing the facts, or the preponderance of evidence prevails. I also compare the preponderance of evidence standard to the beyond a reasonable doubt standard. If the defendant is held to be guilty of negligence, the following types of monetary damages may be levied. Compensatory, to compensate for losses actually incurred. Punitive, to punish the defendant to discourage these types of acts. Bad faith claims, usually against insurers, to punish the insurer from particularly bad behavior. Other, there are several new types of damages that have been argued. They include mental anguish, hedonic damages, loss of companionship. Res ipsa loquitur is a tactic that is used in court that makes it quite difficult for an individual to defend oneself. This process shifts the burden of the evidence to the defendant to show that he was not guilty of negligence. This tactic is typically used where it is not possible or difficult to actually show the cause of the loss, who held the burden of duty, and where the actual failure of duty occurred. Examples include airplane crashes and food poisoning. The jury still decides whether the defendant is guilty or innocent. Even though the defendant is negligent, the law allows some excuses to either eliminate the responsibility or to reduce its impact. First, I discuss the difference between common law and statutory law. Common law, through the process of stare decisis, let the decision stand, laws change very slowly. If prior cases are decided and have the same fact pattern, current cases are decided the same way. Statutory law, legislated law, when common law results are not liked, legislators change the way that game is played. Contributory negligence assumption is that the plaintiff must have clean hands, or not cause any of the negligence. If so, the plaintiff will lose. Causes the problem of the uncompensated victim. Comparative negligence weighs the responsibility and provides an offset. This is a statutory modification. Last clear chance rule is a modification of common law. The one with the last clear chance to avoid the incident is fully to blame. Common law, assumption of the risk is also a defense.